Ever wondered how the stock market works? Well, it's not as intimidating as it seems. Imagine a bustling marketplace, but instead of fruits and vegetables, it's stocks that are being bought and sold. This is the financial heartbeat of our economy, where fortunes are made, dreams are chased, and sometimes, where bubbles burst. It's a place that impacts our daily lives, whether we realize it or not. A market for stocks, indeed. But what exactly is a stock? Let's dive right in and find out. Scene script. Imagine owning a slice of your favorite pizza joint. Now let's dive into the concept of stocks. Picture this. If a company was a pizza pie, a stock would be a slice of that pie. Owning a stock means you own a piece of that company, just as if you had a slice of pizza, you'd own a piece of the pie. Simple, right? Let's delve a little deeper into this pizza analogy. Think about your favorite pizza joint. You love their pizza, and you decide you want a slice of their business. The owners of the pizza joint want to expand, so they decide to sell pieces of their business to the public. They cut the business into 1 million slices, and each slice, each stock, represents ownership in the company. When you buy a stock, you're buying one of those slices. You're becoming a part owner of the pizza joint. The more slices you buy, the bigger your stake in the company. If you buy half the pizza or 500,000 stocks, you own half the company. Owning a stock gives you a right to a proportionate share of the company's profits, and potentially, a say in how the company is run. The owners of the pizza joint might ask you, as a part owner, to vote on important decisions. They might also share part of their profits with you depending on how many slices you own. But remember, as with a real pizza, the size of your slice depends on how many slices there are in total. If the pizza joint decides to cut their business into 2 million slices instead of 1 million, your one slice becomes a smaller piece of the pie. So owning stock is like having a piece of the pizza. It's a way to participate in a company's growth and potentially share in its profits. But where do you buy these slices? Think of a bustling fish market, but for stocks. That's right, we're diving into the heart of the financial world, the stock exchange. Now, imagine the stock exchange as our fish market. It's not your usual market with stalls of fresh salmon and tuna, but rather a marketplace for buyers and sellers to trade stocks. Just like the fish market, where you'll find a multitude of species, sizes and prices, the stock exchange offers a wide variety of stocks. These stocks represent different companies, from tech giants to retail powerhouses. Each stock has its own price, which fluctuates based on demand and supply. Now let's break it down. In our fish market, if a certain type of fish becomes highly sought after, the price will rise. Similarly, if a company's stock is in high demand, its price goes up. On the contrary, if there's an oversupply of a certain fish, or if it's not as popular, its price drops. The same goes for stocks. If a company is not doing well, or if there's a surplus of its stock in the market, the price falls. So, who are the buyers and sellers in this market? Well, the buyers are investors who believe that a company will do well in the future and that its stock price will rise. They're hoping to buy low now and sell high later. The sellers, on the other hand, might believe the company won't perform well, or they might need to sell their stocks for other reasons. Now, you might wonder, how does one actually buy or sell stocks in this market? Well, you do it through brokers. These are professionals who act as intermediaries, helping buyers and sellers make their trades. You tell your broker which stock you want to buy or sell, and they make the trade on your behalf. In a nutshell, the stock exchange is a bustling marketplace where buyers and sellers come together to trade stocks. Just like in a fish market, the price of each stock, like the price of each fish, is determined by supply and demand. So the stock exchange is our fish market. But how do you decide which fish to buy? Imagine shopping for groceries, but instead of food, you're shopping for stocks. Just like you pick and choose items from the shelves based on various factors, you do the same when making investment decisions. When you go grocery shopping, you consider factors like the price, the quality, and your personal preferences. For instance, you might choose organic produce because you value quality, or you might opt for store-brand items to save money. Similarly, when you're investing in stocks, there are several factors to consider. Firstly, you look at the company's performance. This includes examining its financial health, profitability, and growth prospects. Think of it as checking the nutritional value of the food you're buying. You want to ensure you're getting the best bang for your buck. Next, you consider industry trends. Just like you might opt for plant-based products because they're trending in the food industry, you might choose to invest in a certain sector because it's booming. For example, tech stocks have been on the rise in the past few years, attracting a lot of investors. Lastly, don't forget about the economic indicators. These might include things like interest rates, inflation, and unemployment rates. It's like checking the weather before heading out for groceries. If it's predicted to rain, you might choose to stay in. Similarly, if the economy is in a downturn, you might hold off on investing. But remember, just like grocery shopping, everyone's approach to investing is different. Some might prioritize price, while others might focus on quality. It's all about finding what works best for you and your financial goals. And just like you wouldn't put all your eggs in one basket at the grocery store, it's wise not to put all your money in one stock or sector. Diversification can help reduce risk and increase potential returns. So there you have it. Making investment decisions is like a trip to the grocery store. You have to consider various factors, make choices based on your preferences, and always aim for a balanced basket. Grocery shopping for stocks, check, but what happens after you buy? Scene script. Ever thought of being a landlord? Owning stocks is somewhat similar. Envision yourself as a landlord. You purchase a property, and your tenants pay you rent. That steady stream of income is akin to dividends you receive as a stock owner. Dividends are a portion of a company's earnings that are distributed to shareholders. They're usually paid out on a regular basis, often quarterly. So, just as a landlord earns rent from their property, a stock owner earns dividends from the companies they invest in. But as a landlord, you don't just earn from the rent. If property values go up and you decide to sell your property, you'd make a profit. This is known as capital gains. Similarly, in the stock market, you can profit from capital gains. If the price of the stock you own goes up, you can sell it for more than you bought it for. That difference in price is your capital gain. Now let's add a little twist to our analogy. Suppose you're a landlord of multiple properties. The more properties you own, the more rent you collect. In the stock market, the more shares of a company you own, the bigger your portion of the dividends. Your ownership stake in a company is proportional to the number of stocks you hold. And here's the cherry on top. As a stock owner, you're not just a passive investor. You're a part owner of the company. You have the right to vote on important company decisions. So, owning stocks is not just about making profits, it's about having a say in the company's future too. But remember, just as property values can go down, stock prices can fall too, leading to capital losses. That's a part of the game, and we'll talk about managing these risks in the next segment. So, owning stocks can be profitable, much like owning property. What's next? Remember the last time you lost a game? Investing in stocks can feel similar at times. Now let's dive into the risks associated with the stock market. It's essential to understand that the stock market is like a roller coaster ride. The highs can be thrilling, but the lows can be downright scary. When you invest in stocks, you're essentially buying a piece of a company. If the company does well, the price of the stock goes up, and you make money. But if the company struggles, the stock price can go down, and you could lose money. This is the most basic risk of investing in stocks, the risk of losing your investment. Think of it as a game. You're playing against countless other investors, all trying to predict what the market will do next. The game board is full of variables like economic indicators, company earnings reports, and global events. These variables can move the market in unpredictable ways, much like how a roll of the dice can change the course of a board game. But here's the kicker. In this game, even the best players can't predict the market with absolute certainty. Even experienced investors, with all their knowledge and tools, can lose money. This uncertainty, this unpredictability, is the inherent risk of the stock market. But it's not all doom and gloom. The stock market has historically trended upwards over time. So, while there are risks, there are also potential rewards. Much like in a game, the thrill of potential victory can be worth the risk of potential loss. And just as you can develop strategies to win a game, you can also develop strategies to manage your risk in the stock market. These strategies won't eliminate the risk completely, but they can help you navigate the ups and downs, the wins and losses, in a more calculated and controlled way. The stock market, much like a game, can be unpredictable. But how can you manage these risks? Stay tuned as we explore risk management strategies in our next scene. Ever heard of the saying, "Don't put all your eggs in one basket"? In the world of stocks, this old adage carries a lot of weight. It's all about risk management, a crucial part of investing that can mean the difference between making your fortune and losing your shirt. Risk management is the process of identifying, assessing, and controlling threats to your investment portfolio. It's like an insurance policy against potential losses. You wouldn't drive a car without insurance, would you? Similarly, you shouldn't invest in the stock market without some form of risk management. One of the most common risk management strategies is diversification. It's the investment version of not putting all your eggs in one basket. Instead of investing all your money in one company or sector, you spread it out across a variety of different investments. This way, if one sector takes a hit, you have other investments that can potentially offset those losses. Think of it as a safety net. It's not foolproof, but it can help cushion the blow. Another strategy is long-term investing. The stock market can be volatile in the short term, with prices going up and down like a roller coaster. But over the long haul, the overall trend of the market is typically upwards. So, by investing for the long term, you're more likely to ride out the short-term fluctuations and reap the benefits of long-term growth. It's like planting a tree. It takes time to grow, but with patience and care, it can eventually bear fruit. There are other strategies as well, such as hedging, where you use certain financial instruments to offset potential losses, or asset allocation, where you divide your investments among different asset classes like stocks, bonds, and cash. But whatever strategy you choose, the goal is the same: to manage risk and maximize returns. Managing risks in the stock market is all about balancing your basket of eggs. Intriguing, isn't it? From pizza slices to fish markets, grocery shopping to being a landlord, we've covered quite a journey. We've navigated the bustling aisles of the stock market, and hopefully the fog of confusion has started to lift. Let's take a quick stroll down memory lane. We started our journey by understanding what stocks are. Remember the pizza analogy? Stocks are like slices of a company owning pizza, and when you buy a stock, you're buying a piece of that company. A delicious, potentially profitable piece of the company pie. Then we delved into the stock exchange, the grand marketplace where these slices of companies are bought and sold. It's like a fish market, only instead of haggling over the price of salmon, investors negotiate the price of stocks. We learned that the price of a stock is determined by supply and demand. When more people want to buy a stock, the price goes up. And when more people want to sell, the price goes down. We also talked about making investment decisions. We compared it to grocery shopping. You don't just fill your cart with whatever catches your eye. You research, compare prices, read labels, and make informed decisions. In the stock market, this means doing your homework about the companies you're investing in, understanding their financial health, their business model, and their future growth prospects. Then we moved on to the benefits of stock ownership, which is like being a landlord. When you own a stock, you're entitled to a share of the company's profits, either through dividends or the appreciation of the stock's price. And just like a landlord can make money from rent or selling the property at a higher price, you can make money from your stocks. But we also talked about the risks. The stock market is not a surefire way to make money. Prices can go down as well as up. It's like riding a roller coaster. There are highs and lows, twists and turns. But with careful planning and risk management strategies, you can minimize the chances of a stomach-churning drop. And that's where we ended, with risk management strategies. We learned that diversification, or not putting all your eggs in one basket, is one of the best ways to manage risk. It's like having a balanced diet. You don't just eat pizza or stocks from one company. You have a variety of foods or stocks to keep things balanced. Remember, the stock market isn't a mysterious beast. It's just another market, albeit one that trades in stocks. Happy investing! Subscribe, hit the notification bell, and embark on an endless voyage of understanding with us.